I'm sure almost everyone has heard the word stocks before, whether it be through the media or popular culture. But what exactly is a stock? Contrary to what many people believe or have told you, a stock is a lot more than just some letters and prices that seem to sometimes miraculously go up or down in value. So, to understand stocks, it's important to understand what they represent. The goal of almost every business is to eventually make a profit, otherwise known as the money left over after all costs of doing business have been paid. The people who receive this leftover money, if there is any, are the owners of the business. Instead of having to go out and start your own business to make this profit, it is possible to buy a piece of the ownership in an existing company. Therefore, a company can sell stock to people wishing to own and receive the profits a company makes. So, stocks represent the owner's portion of the business, but how much of that ownership is represented in every stock? Well, a business's stock is issued as shares of the business, although stock and shares are often used interchangeably. When purchasing the stock of a company, you are purchasing one or more shares. The total of all the shares in a company is called the shares outstanding. A stockholder purchases shares and therefore owns a portion of the shares outstanding. Each share represents an equal portion of ownership in the business. The more shares you have, the more of the business you own. For a basic understanding, a stock is identified by 1 to 4 letters called the ticker symbol, which is likely a shortened name of the company. The price of the stock determines how much a single share of ownership is valued at a certain time. The price of the stock is not relevant to how large or expensive the actual company is. For example, Berkshire Hathaway Class A stock is currently priced at $313,885 per share, and the value of all the shares combined, or the market capitalization, is $500 billion. Apple is currently priced at $118 per share, yet the market capitalization of Apple is over $2 trillion. In general, a market is a place that typically has buyers and sellers who determine the price of an object being traded. The stock market is no different. It simply is a place where people can exchange objects with other people for money. If there are more people buying a stock than there are selling it, the price will increase. And likewise, if there are more people selling a stock than there are buying it, the price will decrease. Now, this is a topic for many more videos, but the biggest takeaway from the stock market is that the prices of stocks do not necessarily change based on the quality of the businesses. Rather, prices change based on the emotions of the people buying and selling. In a stock market crash, people get extremely fearful and there becomes more people selling stocks than buying them, which pushes the price of stocks down. On the opposite end, during a stock market bubble, everyone and their dog wants to buy, and buy some more. Therefore, the prices go up dramatically with more people buying than people willing to sell. So, are people just crazy? Well, the stock market consists of people, and people happen to be both emotional and irrational. So stock prices very rarely represent the actual value of the ownership in a business. The price of the stock at any time can be far greater or far less than the stock's actual value, or as sophisticated investors call it, the stock's intrinsic value. For a quick example, just so it's easy to understand, think about the American discount store Dollar Tree. In 2008, at the beginning of the Great Recession, the average price for all stocks in the U.S. fell 38% from their previous highs in 2007. In other words, the stock market as a whole crashed 38%. Dollar Tree's stock fell from a price of $14 per share in 2007 to a price of around $7 per share less than 6 months later. However, although it may seem like the value of the business went down by 50% to some investors, some lucky people got the chance of a lifetime. When people have less money due to a financial crisis, what do? Spend less. When people spend less, where do they shop for necessities? Discount stores. For the smart and lucky people who analyzed Dollar Tree and its prospects, it must have been great to see that other people were giving away the stock at such a bargain price. Within a year, the stock price was up to $15 a share and ran up the rest of the recession. So, now you know the absolute basics of stocks and the stock market as a whole. I recommend much more research about stock market investing, and hopefully I'll be able to help you more in the future. But for now, never forget what the legendary investor Warren Buffett has to say about investing in the stock market. Be fearful when others are greedy, and be greedy only when others are fearful. Thank you for listening. Please subscribe and leave a like if you enjoyed, and I hope to see you again next time.